Hi guys, please like, share and subscribe. And if you want full course for any actuarial subject, visit theactuarialguy.com or WhatsApp on this number. Thank you.
So now at this point, I want to discuss with you derivative contracts, what they are basically, and we'll be then going into the detail of two particular derivative contracts in this chapter where we will see what their cash flow structure looks like. And in further chapters, we'll learn various methods to price them. Okay. So let's just get started with that. So let's just get an introduction to this whole thing, right? So first of all, what is a derivative? Okay, and I've just pasted the definition from the material, and it says a derivative is a security or a contract which promises to make a payment at a specified time in the future, the amount of which depends upon the behavior of some underlying security up to and including the time of the payment. Okay. So let's just try to simplify this. Okay. First of all, it's a security or a contract. Okay. So a derivative essentially is a financial contract. Now that financial contract makes a payment at a specified future date. Okay. At a specified time in the future. The value of that amount, what the amount will be, what the payment will be, depends on the behavior of some underlying security. Okay, that underlying security is usually just called as the underlying. Okay, so the value of a derivative is derived from an underlying security. Now, what can be the underlying security? It can either be a share, it can be a bond, it can be a commodity. Commodity meaning it can be onions or it can be wheat or it can be rice or anything, right? All of that. Iron, gold, all of these are commodities. You know what bonds are, government bonds. Share, you already know, a share of a company. Interest rate can also be underlying securities, right? So if an interest rate moves up or down, that determines the payment of a derivative contract. Or an index. Index means the stock market index or any other index. So for example, a very famous one is Dow Jones in the US or NASDAQ again in the US. You have I think Shanghai in China. You have Nifty and Sensex in India, right? And what else? So there are many indexes based on which there we can decide on a contract which pays a certain amount if the contract goes a certain way. Okay. So essentially a derivative is just a contract whose payment depends on the value that the underlying security takes. Okay. So this is what you need to know. Right. Now, particularly, I will just discuss with you two types of derivative contracts here. Otherwise, there are four popular types of them. So there are futures, there are forwards, there are options, and there are swaps. These are four very popular derivative contracts. You can look them up. What is the nature of these contracts? Particularly, futures and forwards are very similar to each other. The only difference is that futures are traded in a market, in sort of a derivative market, which is similar to a stock market, but then there are derivatives there. Okay. And forwards are contracted between individuals. So they are not traded on a market. Basically, it said that futures are standardized and exchange traded, and forwards are basically counterparty or over the counter. Okay. So basically that means that anyone can enter into a forward with anyone and they can design it as they want to. But with futures, the deal is that it needs to be listed on a derivative exchange, and it needs to be standardized. The rules of it are pretty standard and fixed by the stock exchange itself. The derivative exchange itself, right? So what is a future or a forward contract? I'll just give you a very simple example. So a futures contract. Maybe do I have an example here? No, I don't. Okay, so let me just give you a very simple example. So suppose the price of a particular share, I'm talking about the future of a share. Okay, so let's say the price at time 0 of a share, let's just call it P0 right now, is equal to 100 pounds. Okay, so this is the price of a share. Now, let's just say there are two people, okay, and I'm describing a forward here. So there are two people. Okay, there is person A who believes that the price will go up by time t. Okay, and there is person B who believes that it will go down. Right? So these two people, they have different beliefs. Person A believes that the price will go up, and person B believes that the price will go down. Up or down with respect to what? Let's just say 100. Okay. So they contract with each other. Okay. So let's just say they have very specific expectations. So person A believes that the price will be more than, let's say, it will be more than 105 pounds. Okay. And person B believes that it will be below 105. Okay, so it won't go down, it will be below 105. I'm actually taking this price that they're contracting upon to be different than 100 to make a point that it can be different. It need not be with respect to this price itself. Okay, so this is basically the price which they are contracting on. I'm not getting into the technical jargon of what it is called. Okay, so basically A believes that the price will be more than 105 and B believes that it will be less than 105. So they enter into a contract that A will buy one share whatever the share is from B for 105 pounds. Okay, this is the contract they enter into. Okay, so they've already fixed the price right now. This is basically the forward price. They have fixed a forward price for this contract. They believe that this will be the price, and A will buy this share from B for 105. Okay, so if the price at time t, if the price at time t is greater than 105, okay, maybe let's say it's equal to 106. Okay, right, then what will happen? They have already decided that A will buy the share from B, and now he will have to buy it, he will buy it for 105, right? Because that's already contracted, this is fixed. But let's say the market price, open market price of this share becomes 106. If it becomes 106, then A can simply buy for 105 and sell immediately. So A buys and sells immediately in the open market. Okay. So this is what happens. A buys and he sells immediately into the open market. So what will be the price that A buys for? They'll buy it for 105 because that's the contracted price. He or she can sell it immediately for 106. So A makes a profit A's profit will be 1 pound. Okay, so this is how a forward contract works. Basically, you decide upon a price at which the seller is going to sell the buyer the asset. Okay, and obviously B suffers a loss because he or she will have to buy it from the open market for 106 and give it to A for 105. So the loss of B is equal to the gain of A. Similarly, if the price at time t was equal to 104 instead of 106, right? So if this was the case, then what will happen is that A will have to buy for 105 even when the open market price is 104. So again, what happens is A buys for 105 but is only able to sell for 104 because that's the open market price. No one in the open market would buy it for 105 now, right? But A is bound by the contract itself, right? So what happens is that A buys it for 105 and sells it for 104, and thus A's loss is equal to £1. Similarly, B will have a gain £1 because B basically can just buy it from the open market for 104 and sell it to A for 105 and make £1. Okay, so this is the idea. Okay, so whenever the price goes higher than the contracted price, it's the buyer who benefits. Whenever the price goes lower than the contracted price, it's the seller who benefits. Okay, so that is how it works, and this is a forward contract here, right? And futures are very similar. They are just exchange traded. Swaps you can look up. You can just go and see what swaps are. Okay, I am not going to discuss them here. I'm going to get into options now directly. So let's just discuss options. Okay, so what is an option contract? So an option gives an investor the right but not the obligation to buy or sell a specified asset on a specified future date. Okay, so basically the investor, the buyer of the option, gets a right to buy or sell. So there are two types of options. There can be a call option or a put option. Okay, the buyer of a call option, the person who takes a long position on a call option. Remember, buying something is same as taking a long position. So the buyer of a call option has the right to buy an underlying asset, a specified asset on a specified future date. The buyer or the holder of a put option has the right but not the obligation. Right but no obligation. Under options you have a right but no obligation to sell a certain specified asset at a certain specified price. Okay, so let's just read through this and then I'll give you an example. Okay, so the holder of an option is not obliged to trade. Okay, there is no obligation. There is just a right to buy. If you feel it's not profitable for you, you won't buy, right? So it's quite an interesting derivative contract. Hence the name option, and will only do so if it is profitable. The other party is known as the writer. Now, if you have the right, if someone has a right, someone else has to have the obligation. So the writer of the option has an obligation to sell the holder if the holder wants to trade, if the holder of the option wants to trade, right? So basically, if it is a call option, then the buyer of the option, the holder of the option, has the right to buy, and the writer of the option, the person who has given this option to that person, has the obligation to sell. Similarly, in case of a put option, the buyer of the option or the holder of the option has the right to sell. Okay, but the writer of the option correspondingly has an obligation to buy if the other party wishes to do so. So how is this different from a forward contract? Well, under forward contract, both of them were bound by the contract. Here, one party has a right, he or she is not bound. The other party is bound if the other party wants to bind him or her. Okay, so that is how it's different, right? You're giving someone a right and the other party has an obligation, right? So that is how it works. And why would someone write an option then? Why would they subject themselves to an obligation and give the other party such an advantage? Well, the point is that the options writer, the person who writes an option, the one who has an obligation, always collects a premium from the holder for giving the holder the right to exercise or not to exercise the option. So this right comes at a cost, and that is the premium. That is the price of a option, right? Call option gives the right but not the obligation to buy a specified asset on a set date in the future for a specified price. So this is what I have told you. Call option is the right to buy. Put option gives the right to sell on a specified on a set date the specified asset at a specified price. Okay, so basically if you have a call option and if you take a long position on it and that you buy it, then you have a right to buy an asset at a specified price at a specified future date. We'll talk about the date aspect as well, but just consider it to be any date in the future. Okay, if you sell a call option, okay, that is if you write a call option, then you are at a short position and you have an obligation to sell the underlying asset. What can be the underlying asset? It can be a share, it can be a bond, it can be anything. So you have an obligation to sell the underlying asset at a specified price. Okay. On the other hand, put option, you have the if you buy a put option means the right to sell. Okay, right to sell what? The underlying asset. Okay, at a specified price on a specified future date. If you sell a put option, then you have an obligation to buy, right? So it's always the seller of the option who was on the obligation side to either buy or sell, right? In either of the cases, right? And the buyer of the option always has the right to buy or sell in either of the cases, right? So that is the idea. Okay. So let me just give you an example here. Okay, before proceeding further, just to describe the contract. Okay, so let's just say there are two people again, A and B. Or let me just repeat the previous example and just try to analogously change the nature of the contract. Their beliefs are the same. Okay, so there are two people. Person A, okay, it's also the same share itself, which we'll be working with. Okay, so very similar, the exact same nature of the problem. Share, the price is 100 right now. Two people believe that at a certain time t, okay, the price will A believes that the price will be more than 105 and B believes that the price will be below 105. Okay, so let's say A buys a call option to buy the share at 105. Okay, because he believes it will increase, so he will want to buy it for 105 and expect that the price is higher so he or she can sell. So A buys a call option to buy the share at 105 from B. So B has an obligation, okay, at time t. Okay, so very simple sort of contract that I'm taking here just to explain the idea of option itself. Okay, so now let's just consider cases. Okay, so A is buying a call option because they believe that the price will be higher than 105 And because they believe that the price will be 100 and higher than 105, they want a right to buy it. But if it goes below 105, they don't have an obligation, right? So case A, let's say the price, and what is the price at which A buys? So that, let me just describe a more wholesome contract to you. Okay, so A buys a call option to buy the share at 105 from B at time t, and the price of the call option is equal to, let's say, £1. £1 is the price at which A gets this option. Okay, so ideally the pricing will be done by us later on, but I'm just assuming that the price is £1 itself. Okay, so yeah, it's just an assumption. We will learn the pricing later, but the idea is that at time 0, to buy the option, A will have to pay B £1, right? So that B gives him or her the option, right? So let's say the price at time t of the asset, okay? Let's say the price at time t of the asset is equal to £107, okay? So now A knows that the market price of the asset is 107. He or she has the right to buy it at 105, right? Will he or she buy it or not? Okay, that's the question. The answer is yes, A will buy it. Why? Because the asset is worth 107 in the market, and A can buy it for 105 and immediately sell for 107 and make a profit of £2. So A exercises the option. That will be your conclusion, right? A exercises the option. And what will be the profit of A? It will be the price at which he can sell it in the market, open market, the share. So once he buys it, he can just immediately sell it. The price that the exercise price of the option that he or she will have to pay to B for buying this option. Okay, so this is the profit at time t. But also A had to pay £1 additional for the price of this option. So this will also not be kept by, with A. Okay, you need to involve time value of money here, because these two transactions are actually at time t. These are occurring at time t, and this is occurring at time 0. Okay, so you need to involve time value of money, obviously, but then I am doing it very simply. So I'm just saying, if there is no time value of money, then how does it work? So 107 minus 105, so you make £2 immediately, and then you had already paid £1, so you make £1, right? Again, very simplified case, no time value of money. We'll see how a time value of money gets involved here. Let's see the case B. Okay, so now A made £1. Oh, what will it be for B? For person B, it would just be the opposite. Loss of B will be, whatever is the profit of A will be the loss of B. That is how it works. That's how simple it is. So basically, B has to buy the option in the market for 107, buy the share in the market for 107, sell it to A for 105, and B already received £1 when he gave A the option. Okay, and thus B loses £1. Okay, so this is exactly identical to the profit of A, right? So that is how it works. Okay, very simple. Now let's just consider another case. This is case B. Okay, now under case B, let's say the price at time t of the option is actually equal to 104. Okay, so if the price of the option goes to 104, okay, this is a call option. A has a right to buy. If the price of the asset is 104 at time t, of the asset, not of the option. Okay, so now A has an option to buy it at 105, right? But the market price is 104. So A can buy the asset in the open market for 104, right? Instead of buying it from B for 105. Also, A does not have an obligation. A has a right to exercise the option. He or she may choose not to exercise the option, right? So that is a possibility which is there, right? So in this case, A will not exercise the option. Why will A not exercise the option? Well, it's actually very simple. Because if A exercises the option, they lose money, right? They will then buy it from B on 105 and then sell it in the open market for 104 and then lose money. Why would I buy something which is worth 104 in the open market for 105? So A won't exercise the option, okay? So what is A's profit or loss? So A will suffer a loss in this case. A's loss is just that £1 that he or she paid to B in the beginning of the contract. Okay. So A's loss is actually limited. The maximum loss that A can suffer is just £1, right? He or she cannot occur a loss of more than that, the original price that was paid, right? Because if the price is below the contracted price, the exercise price, then he or she will choose simply not to exercise, right? So this is A's loss and this is B's profit as well. Right? So this was the case of a call option. Okay. What will happen in case of a put option? Let's say this time, instead of engaging into a call option contract, the parties decided to engage into a put option contract. So so now who will buy the put option and who will sell the put option? Depends on what their pricing beliefs are. Who believes that the price will go up? A believes it, right? So A would want to at that time buy the option, right? And B would want to sell the option, right? Because they believe that price will be lower than 105, right? So B believes that the price will be lower. So B would want to sell, right? So B will buy a put option from A. Okay, let's say this is the thing that is happening. Make sense? So what will be case A? Let's just say the price case A is same as before, that is the price is 107. And the exercise price here is 105 as it was before. Okay. Now the price goes higher. Now B has a right to sell the contract to A for 105. But the point is B can sell in the open market for 107. So why would B exercise this option? So B won't exercise this option. Okay. And what will be the profit of or loss of B? B's loss is that initial £1 that they paid in order to buy the option. Okay. And A's profit is the same thing. Right? Here you must realize that again B's maximum loss is limited because they are the buyer of the option. Okay. And analogously, you can also try this case where the price goes to 104. There what will happen? B will exercise the option because B can, okay, let me write this one as well for you. Okay, let's see case B. Price at time T is equal to 104. Okay, now B will exercise, right? B will exercise this option and sell to A for 105. That was the contracted price, the exercise price, right? So what will be B's profit or loss? So B will actually exercise this because they can sell for 105 and buy for 104 in the open market. So what will B do? B will sell for 105 because they have a put option, and then buy for 104, right, in the open market. So they made £1, and but the point is they also paid £1 initially to A. So that will be paid. So no profit, no loss. Zero is the profit or loss, right? So 105, you buy it, you sell it to A for, then you buy it from the open market for 104. But also the fact that you had to pay an initial premium, so that's gone. So it's just zero. Okay. Similarly, A's profit will be equal to zero. It will be the same as this. So this is the preliminary idea of an options contract. I hope you would have understood it with this example. Okay. So let's just now get into other things. So I want to discuss the timing of the contract with you. Okay. So based on the timing of the contract, there are two types of options. There is European options and there is American options. Remember that these names don't have anything to do with the Europe or America. The names just have historic origins, where they originated and is how they're named. But the important point that you need to note about European or American options in this case is that European options can be exercised only on the expiry date. So there is one particular date of expiry, okay, where it can be exercised. That is where, if you see if your price is higher or lower with respect to your exercise price, then you decide whether you want to buy or sell or whatever the nature of the contract is, right? So it can only be exercised on one particular date. In case of an American option is quite flexible that way. It can be exercised on any day before the expiry. So all throughout the period before the expiry, if the buyer of the option wants to exercise, they can exercise. Okay, so that's the difference between a European and an American option. Okay, so let me just continue from here. Okay, so now let's just look at this very simple question. It says an investor has a short position in an American put option with an exercise price of 20 pence and an October expiry date. Okay, so describe the nature of the contract that investor has entered. So they have a short position on an American put option. A long position on an American put option would have been a right to sell, right? So a short position on an American put option, or simply put, a put option, is an obligation to buy. So the investor, first of all, investor has an obligation to buy. Why? Because they've taken a short position, that is, they've sold, right? They've sold an American put option. Okay, so they've sold a put option, which is the opposite side of an option to sell. So that is an obligation to buy, right? Buy the asset, the underlying asset, at 20 pence on any date before October, right? So it expires in October. So any day, so the obligation is there up to October. Up to October, right? At any time up to a date in October. So it can be any date. You can assume 31st October, but since they haven't said anything, so up to a date in October. Okay. So that's the deal. And basically, this investor would have received a premium in exchange of this obligation, right? So, yeah, they've undertaken an obligation. So, obligation to buy, that is, they have given someone else the right to sell. So, they would have received some uh, premium, right? So, that's the idea of this.